The FTSE 100 hovers near all-time highs, but where next? Welcome to Market Insight, I'm Peter Devlin. Amid market volatility spurred by US recession fears, concerns over AI spending and presidential posturing, the FTSE 100 has remained surprisingly resilient, averaging a record high in May at around 8,445. The FTSE 100 currently stands a few percentage points away. So what lies ahead for the UK stock market as we enter the final quarter of the year? So to help answer that and more, I'm joined by Russ Mould, Investor Director at AJ Bell. Welcome, Russ. So you've said in your notes that the FTSE has not stayed true to type in 2024. So why have UK equities performed solidly this year?
I think the first advantage that the UK equity market has is that perversely it hasn't done that well. So it's just not very expensive. It's relatively cheap on an earnings basis. It's certainly offering a very plentiful cash yield once you take into account not just dividends, but mergers and acquisitions and buybacks. And also it does have a perhaps at last a little bit of a whiff of political stability to it, which has been lacking for a long time, something that may help it stand out against, say, relative to Europe or, I want to say, even the United States, at least ahead of the November presidential election.
So Goldman Sachs analysts, they're expecting the FTSE 100 to rise to 8,800 over the next 12 months. Do you see this as a reasonable outcome?
It is. I mean, intriguingly, one thing that may be a bit of a handicap there is the strength of sterling, which is now 133, 134 to the dollar. That could put a little bit of a crimp on some of the overseas earnings when translated back into pounds. But I can see the argument for that. Again, if the UK economy gathers a little bit of traction after last year's recession, you do have some global economic exposure there as well through the miners and the oils. And again, it's just not very expensive. And if you throw in £80 billion of dividends from the FTSE 100, 11 from the FTSE 250, £50 billion of M&A this year, £50 billion in share buybacks. That's 180, 190 billion pounds. That's a 7.5% cash yield. Again, that must be catching somebody's eye, particularly at the time when interest rates should be on balance going down, not up again.
So Russ, updated research from the OECD today, they're seeing no longer the UK, the economy as the G7 growth laggard. So will faster economic growth attract investors to the UK markets?
I think you're already seeing signs of that through the currency markets with, again, sterling at that 2-year high against the dollar and against the euro. That's one great way in which financial markets will express faith in a country's economic prospects or lack of them. Geopolitical stability will also help. But you're right, the equity market isn't perhaps quite as confident as the currency markets right now, but a little bit of economic growth after last year's recession could go a long way.
So you mentioned political uncertainty as well. A belt-tightening budget is expected from the new Labour government in October. Are you expecting a major impact to the FTSE?
I think there's a lot of fear in the market at the moment, and it's possible that weak GfK consultancy UK consumer confidence reading last week has maybe prompted the Labour Party to at least reposition its rhetoric. They haven't given too many hints right now. I mean, the challenge that the UK has got is that debt to GDP, as we know, is high. The new government has made some very strong promises on what it won't be changing tax-wise, so it's probably relatively limited there. We shall see what they do, for example, to things like capital gains tax or windfall taxes. But my guess at the moment is, judging by the way which the Labour Party dialed back some of its rhetoric this week, that fears are probably somewhat overblown. But we'll see on the 30th of October.
So finally, Russ, just turning to the monetary policy outlook, markets overall been pricing in an aggressive series of rate cuts from the Bank of England. That's despite policymakers calling for a cautious approach. So if interest rates stay higher for longer, will we see UK equities plummet?
Well, that's a good. I mean, if they were to tip the UK into a recession, or the US were to unexpectedly go into recession, that would make things much more difficult. Again, at the moment, I think you're seeing that higher for longer narrative perhaps play out more in the currency markets, which would put a little bit of a brake on the UK equity market. But equally, if rates are staying high because the economy is doing okay, that might not be such a bad thing.
Russ Mould from AJ Bell, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.